Welcome to the Tactical Brief, ladies and gentlemen, to a new issue of the Grey Market Talk with one coronated market maker. That would be me. You hear it from my voice, so I thought, how can we keep that simple, Nick, and not too long? And we decided we are going to talk about the steepener we see in the market, which is identified as a bear steepener. And probably it gets longer and more complicated than we assume, but we'll see it. Hello, Nick. Thank you very much for joining me.
Good morning. Get well soon, as they say.
Yeah, well, I definitely do not have corona because I'm vaccinated twice and I have a booster jab. So as they promised me by putting this stuff into my body, the one thing I cannot have is corona, right?
Yeah, that's what they say.
Yeah, absolutely. I don't trust our government and everybody. So, could it be any different? Yeah, big pharma is big cool. I like pharma, so I'm not having corona. I just have a normal cold, which made me sleep almost 48 hours in a row and feeling like death warmed up, I think is the English expression. Anyway, I haven't introduced Nick. Nick, Chief Investment Officer with billions and trillions and trillions and trillions, like Carl Sagan used to say, assets under management. The man I turn to when I have questions about the yield curve, the bond market, the equity market, Elliott wave, all the things we are striving for. And we will not have today thoughts from abroad, because I thought, I'm asking you on air, Nick. I wanted to raise that earlier. Do you mind making a Monday where we can discuss the elections in Germany on Sunday and happening in Bavaria and Hesse, so we can analyze what's going on?
Gladly. Yeah, as a non-voting constituent here.
Exactly. You can be the neutral observer, while I'm the one who's probably has more skin in the game as a German in what's happening. So it will not be Sunday next week. It will be Monday. Then we have the live data and can put an analysis, which I think will have severe implications also on the policy of the ECB, how they're going to treat our economies. The voters in Germany now, especially in Hesse and in Bavaria, will have a big choice to make what to do, and that will have severe implications on government policy. So everybody knows next Sunday you will miss out. We'll do it on Monday live and post it on Monday evening. So let me put up the presentation. Let me share that. This time it's only one slide, and we will go live into a couple of charts because that makes a lot of sense today. Grey Market Talk, 1st of October. I had a nice joke. No self-respecting Yorkshireman would ever turn the heating on before October. So we've reached that now. Coming into the region, even though it's freakishly warm, isn't it?
Well, it's not bad, but I must say I'm in the process. We've got a huge castanea, horse chestnut tree. It's not the edible type here, and I spend my days just sweeping up the leaves. And normally by mid-October they've kind of all gone, but this year they've lasted a bit longer. So whoopee-doo, the climate must be doing well.
Well, we could need it if our energy situation stays as it is. I heard an interesting quote. Before I come to the slide, let's look at then, because that is actually an interesting point. You remember we talked a couple of weeks ago about China increasing their strategic petroleum reserve massively, while the US is actually reducing it. And Vincent gave in a podcast, he actually said, because he lives in China, and I found that take very, very interesting, is that, yeah, everybody was assuming that the strategic petroleum reserve, they're building this up because Taiwan and a potential war and you name it. And he said, I haven't heard the conversation. I thought that was a very interesting take, is maybe Putin, new best friend, told them that if there's a cold winter in Europe, he's going to weaponize for the first time oil and gas supply the real way. So if you simply reduce then the output in Russia, prices will go through the roof. So he won't even lose any money. He will pinch the supply hose. And United States strategic petroleum reserve already on a low. Germany will be definitely in trouble. We will not get all the energy we want from France because they don't have enough to put that into our grid. And that could be a good explanation that somebody stuck it to the Chinese and said, you better build up your reserves, because that would be a really nice move. What do you think about that take?
Well, I mean, these people are also businessmen. Yeah, I mean, so if
Not
you
like
can see
ours, Nick. Not like ours in Germany.
if you can see a short in the market, which is the US Strategic Petroleum Reserve, and you see winter coming along, you get your little calculator out, you say, hang on a minute, let me see what I can do here. And I guess that's what's going on. BRICS taking full advantage of this thing. They control 50% of the oil. This isn't going to be the one and only time that, it's not only the Americans that can weaponize the dollar. I mean, you now have a group of people that rightly should be able to use their resources, the right way. So, yeah, my guess is that, buy low, sell high is the name of the game. And I think they'll probably do that.
The dollar vigilantes, that's a new term. It used to be the bond market vigilantes, right?
There still are the bond market vigilantes if you look what's going on. But yes, I mean, it's all about the dollar. I mean, ultimately, but we'll talk about bonds today, I guess.
Yeah, well, actually.
If it was the dollar vigilante, right, and you had all the bonds, falling, and you get these scenarios. I mean, let's face it, I was talking about these scenarios a year ago. Now I see everyone talking about these scenarios. If it really is sort of the death of the dollar right now, and that's why treasuries are collapsing, you wouldn't see the dollar rallying. So this is a totally different, market interpretation. I think people, so I don't think I got it right.
Okay. Are you seeing the nasty TLT?
I see that. That's TLT.
Yes, lovely. Interesting. You can see it. I can't see it on my screen. See, must be the cold. So you're seeing it, yeah?
I do see it. Yes, you've obviously shared your screen.
I shared a different screen then, obviously, yeah?
Don't press that. Don't press that.
Oh, wait a second. No,
press the red button. I'm not sure if that was good.
So I'll open it again. No, actually, well, we can already vamp it on because it's one of the most interesting charts. While lying in bed and suffering not from corona, but the normal cold, I had a lot of time to listen to podcasts, and pretty much every podcast I was listening to is talking about the steepener we see at the moment in the yield curve. Nick, would you mind to explain actually just a quickie for my students who are not in the markets for a million years, what is a yield curve and what is a steepener? As briefly and intelligible as you can possibly do it.
Oh, well, that's put me on the spot. Okay, a yield curve is a maturity plotted against the interest rate for a particular instrument. So for the US government, for example, let's just say 1 to 30 years, each maturity has its own yield. And therefore, if you plot that curve, that's your yield curve. And you can plot a yield curve for General Electric, they issue 5-year bonds, 7-year bonds, and each maturity has its own yield. Join the dots, and there's your curve. So that's the yield curve. What was the other question?
The inversion of the yield curve. By the way, yield curve, I found that very interesting. When I entered university, I thought the concept of yield curve is as old as time itself. No, it's actually the Salomon bond traders who actually came up with the idea first, to make a plot, actually connect the dots and say, oh, look, we have a beautiful curve here. We can do something with that.
A lot of good things came out of Salmon's.
Yeah, in the 70s. So just as a little reminder, the other question is obviously the topic of the day. And I've already put the 10 versus 2 years, the yield curve, on the screen. What you can see here, we look at 10-year yields, subtract the 2-year yields, and get the highly inverse. Here's the 0 point, actually, if I tune out a little bit. Let's go on everything we have in here, going back to 1989. That's where we are at the moment, right? We have 2 years yield more than 10 years, which is a very bizarre situation in normal times, because the longer you lend out money, usually, the higher the risk is that you'll get it back. So you want more in terms of yields for that. And the one of the surefire recession signs, at least since the 80s, was if this inverses crosses the 0 line, we are pending a recession from a time horizon from, let's say, 3 months to 18 months, somewhere in between it will happen. And we are now waiting 1.5 years.
Yes, I know. The interpretation of the yield curve is, I don't think it's as it used to be. So the world has changed since the global financial crisis. And at least certainly in the last 15 years, you've seen this absolute flood of money which has left the rest of the world, right, and gone into the USA. So the USA have kind of benefited from the flow of money which has come out of Asia and out of Europe and into the US. That's sort of the first thing. So it's got to go somewhere, right? So where's it going to go? It's going to go into equities and bonds, and equities have obviously outperformed every other equity market pretty much. And the bond market has received a lot of cash as well. So one, you get a flow of funds. And secondly, you've got the situation that the amount of derivatives and loans that are, if you like, backed by collateral. You know, what's the best collateral in the world is going to be sort of the top government bond market. So the US Treasury, you know, the Bund, the German Bund, at least it used to be. Let's see where that stays. You know, one or two others. And, you know, once you use collateral as your sort of backing for a loan, then you need to buy stuff and store it somewhere, right? And that also influences, you know, the yield curve, because if they use collateral 5-year, 10-year, you know, this is going to, you know, influence where the yields are. Yeah, more demand. So that kind of whole process of flow of funds plus collateral means that if you like, the theoretical point where you might expect the 10-year yield to be based on, let's just say, forward interest rate curve, it's not there. And the difference between the theoretical rate and the actual rate is the term premium. And the term premium, let's just say, if people say that the theoretical yield of the 10-year should be at let's just say 4.5%, 5%, with short rates at 5%, then you'd say, well, term premium is 0, because that's where we might be. But if the yield is 4% and the theoretical rate is 5%, then your term premium is 100 basis points negative. And what we've had is a very, very negative term premium for a while, I must say. And so, you know, the term premium could be distorted by the fact of collateral or flow of funds. So we shouldn't basically say, okay, you know, the curve therefore will eliminate all the term premium. But at the moment, in the last few weeks, you've seen term premium reduce from minus, and there are different calculations for the term premium, but I use the one which is on the, you know, the Fed website, the Federal Bank of Federal Reserve in New York. And that term premium has moved by 50 basis points in the last month. So it's normalized, if you like. And why is it normalized? Well, you know, partly supply, partly expectations might have changed, partly, you know, there could be many reasons. How much more has it got to go? Don't know. But, you know, that's what's moving the, if you like, the price of the yield of the long end, and therefore the relationship of the long end to the short end. I mean, the other way to look at this is that the Fed have kind of said, believe what the Fed say if you want, but the Fed have kind of said, well, we might be coming to an end, but if we come to an end, we think we're going to sort of keep the rates higher for longer. So this higher for longer narrative that's been running around, and on the basis that you think higher for longer, then you'd say, okay, well, you know, therefore perhaps I've got too much expectation for rate cuts in my yield curve, and therefore I take off some of these rate cuts. So I'm pushing out, making the 2-year yield higher, therefore the 3-year yield higher, and therefore that sort of filters through to the back end of the curve. And then there's one more reason, and that is, of course, if people had been expecting, that was your lead into the question, a recession for the last 18 months, and they're wrong, and they kind of look at the growth numbers, and they're saying, well, hang on a minute, we're not going to have this recession. Or if we are, it's going to be minor. The market has got that totally wrong. What the hell are we doing with a negative yield curve? So again, it's a repricing of the long end on the basis of expectations. You say, well, okay, if I'm not going to have a recession, why should I have a negative yield curve? I mean, if you're wrong, you're wrong.
That's why I asked the question, which or put it in the wrong place, wrong time. I've pulled up. Can you see the business cycle, the quad model?
Yes.
Yeah, very simple model, and you've seen my, hopefully, in German, my presentation on this whole thing, 1.5 hours long. I've translated it into English, the couple of things we had on here. It's a very simple model. We have 4 quadrants in our business cycles: recovery, expansion, slowdown, and a recession. And what you see here on the right is interest rates are going up. I have that represented in red. Yeah? And this is a steepener, what we can see here. A steepener is just as we were talking about it, yeah, 10 years are rising faster than 2 years. All right, where would you expect that? If the economy is in an expansion, when we are actually in quad 2, yeah, you might call it reflation or whatsoever. And this model, as simple as it is, it would have given you fantastic signals last year for the last quarter. Yeah? You would have been invested because we would have been in the recovery or Goldilocks into reflation trading. So looking at what's happening at the moment, the market still suggests me that we are still in the expansion phase here. And that's where my mental arithmetics break down. Because yes, okay, fine. If everybody says we are still in expansion, there is a risk for higher inflation. In the longer end, the market will price that in, and 10 years will rise. The rates will rise faster than 2 years do. But now we have the situation where I can't get my head around and say, are people really expecting, I'm not, that the economy is on the right track and that we'll see huge growth, and therefore we see this steepener in the yield curve, which is a bearish steepener because interest rates go up and the curve goes steeper. As the chart here suggests, we are at this part of the equation. If I just flick it over 180 degrees to this side, to see a steepener happening soon, but a steepener in the other direction. 2 years will come down dramatically because the Fed will realize, we blew this. We were too high for too long. The economy will tank. We take 2 years down. That is usually when you have this optimistic scenario that the Fed is reducing rates, when the equity markets actually take the final dump. That's when they go into a tailspin, because everybody, even the last moron, will realize, oh my God, earnings are coming down. We are in this scenario. So it doesn't, in my head, it doesn't fit together. The market symbols this, which is a positive outlook for the economy, which I think it isn't. And then the question is, Nic, are we seeing this scenario of a steepener representing by yields going up, 10 years going up more, by an optimistic outlook on the economy, or are we still not having buyers in this market anymore? That's why yields goes up.
I think, as I said, I think there's A and B. So you've got a situation where people have kind of bet on this recession and they've got it wrong. And so yield curve inversion wrong. And then you've got the fact that at the same time, and this is why every situation, every market environment is different, and so you've got to sort of qualify a lot of the theoretical playbooks that you've got each time. So you say, well, what else is going on right now? And what else is going on is that the Treasury, or the government in the States in particular, have an almighty deficit. We've been talking about this for the last year plus, and that is clear that is not being funded anymore by Japan stroke China, which it used to be in the good old days, and is now being financed by Europe stroke UK. Okay, that's where the money is coming from overseas. But the rate of the purchases from overseas is something like an annualized basis of about 2.5%. So the money that's coming from overseas, which used to finance the deficit in America, is slow versus the rate of growth of the deficit and the funding requirements in the States. So you now have gone from a situation where the budget deficits were fairly manageable in the past and could be dealt with by in the old days, Japan stroke China. Now, it's still great. I mean, the rate of growth hasn't really changed, right? from overseas. But what has changed is the demand for issuance, or the amount of issuance that's going to come over the next 10 years. And you can look at the Congressional Budget Office forecast, and I've said it so many times in these videos, that it is scary what you see. It is absolutely frightening what you see, because the rate of expansion of this deficit just is forever increasing. It's like, you know you're not going to get your money back from profits, as it were, but you continue to lend money to the government. But you know that because they are the dominant currency, that they will be able to refinance it. And this is the bit that I think is kind of frightening the market right now, is they've realized late, okay, been talking about it for ages, they've realized late that the bigger factor is not, partially, as I say, growth issue and recession, no recession thing. But I think it's dawning on everybody that the US will be the forever issuer of debt, and the requirement to finance that debt can only come from the US, because, as I say, the rate of financing that's coming out of Europe, Asia, and all of these other places is just not fast enough. So the US have to finance it. So if the US finance it, actually what that does is it takes money out of, if you like, economic growth to just keep buying bonds. You go to the bank and you say to the bank, can you lend me money for my business? I've got a great idea. And the bank say, sorry, I've got to buy some bonds. You go to the market and say, I've got a great idea about energy and whatever. Sorry, I've got to buy some bonds, because the whole of the American economy now going forward is going to be focused on financing the US government's deficit. And where does the money go? It will be fine if it went to sort of true growth, what I would call, as opposed to sort of, you give somebody some money, they go and buy some food, and then you give some people more money, and then you go and buy some more food. The business model itself is in doubt, and therefore, if the money has to come from, just by printing more money, that's really the death knell. And where does this all end? Because we have to say, it's not just a disaster. You can imagine, and this is the thesis for a long time, is that once you get this, what you call bear steepening, and higher yields in the 10-year, the cost to the American government, they can't just now run from treasury bills into the long end and finance themselves at a cheaper rate because the yield goes. They will be financing themselves at a very high rate for a very long period of time, and that will make worse this whole budget deficit thing. And there will come a point where the rates will be intolerable for the government. I mean, think about it. We're just having another argument about, government shutdown. This is, again, all about budget. It's all about where we're going to put the money that we don't have, right? And there are arguments about we shouldn't be giving it to Ukraine. We need the money for ourselves. And so the bigger these debates go about where the money goes, the more people will realize that actually the bill for the interest rate that you have to pay on all of this debt is just phenomenal. I mean, they were arguing about a 7 billion check to Ukraine when the bill for interest rates is rising towards $1 trillion. I mean, put it into context, and there's going to be some smart senator who's saying, well, hang on a minute, why are you doing QT? Shouldn't you be doing QE? Shouldn't it be capping yields? Shouldn't you be reducing the cost to the American people for financing the debt? In the way that the Japanese have done over the years, and the Americans will go that same way, in my view.
Well,
I can't even remember the question.
Where you put me straight on that financial repression is the ultimate way out of the situation we are seeing at the moment. But they will obviously, at least in my view, only resort to that after something massively broke down. in the markets before they can't do it. Otherwise, they will be the perpetrator of this high inflation. Well, how do you actually want to call a scenario like that? You have artificially low interest rates because the sovereign is otherwise not able to pay its bills. On the same time, the man on the street gets his or her savings taken away by real inflation, which will inevitably be caused by this scenario. What would be the first signs of a break like this, Nic?
I don't know whether you need to see a break in the economy for financial repression to take place. I think you need to see a break in government. And wherever you look, whether it's the German sort of, the traffic light coalition or whatever they've got here, who can't organize themselves because where does the money come from? When governments start to realize that they are constrained, when people who rule people realize they're constrained by money, and there's some sort of theoretically independent body, ECB, Fed, Bank of England, who are constraining them. I think that's where it could come from. It doesn't necessarily have to come from the world is falling apart, therefore we have to cap rates, because you cap rates and then you sort of cut rates and then you're sort of back into disaster zone. I think the government will intervene much faster than you will see a collapse in the economy, because if the economy collapses first, then they've got it again wrong, right? Then they've gone too far. Then they've sort of stretched the elastic band way too far. And I don't think they're going to be allowed to do that. And I believe that these debates that we're seeing in America, we had one just a few months ago. We have another one today. Okay, the nature of this thing, it's not about borrowing. This is about sort of allocating the budget. But it's the same thing. When governments start to fail to function, that's when they will intervene before the Fed waits for the thing to blow up, in my view.
And let me ask you, for one of the big boys, obviously he's quite vocal about that, Bill Ackman of Pershing. He is massively short the long end. And in an interview, I heard him say, well, I simply believe that what they're offering at the moment on the 10 or the 20-year side, 4.5%, or on the 30 years, 4.7%, as a contract with a debtor is far too little. That's why he stays short in this scenario. I just pulled up the TLT chart here at the moment because I did a trade at the beginning of the year. First I was right, then I was wrong. Then I stopped after you put my head straight in what you just repeated, in which direction we are going, and that the Chinese and the Japanese are actually, well, selling off their treasuries, and that the financing has to come out of the United States itself. What we are seeing here on this chart now is that we're at 88.69. I pulled up the BlackRock iShares fact sheet on the side, and they say it has an effective duration of 16.5 years. You can actually, if you don't know anything about bonds, and correct me if I'm wrong there, if interest rates go up by 1%, the TLT would lose 16.5% and vice versa. So that's pretty much the calculation, as you can see that. And let me put out the
let me just sort of comment on this. Yeah. And as I was explaining to you earlier, it's quite comical. I do tell you I watch a lot of snooker and golf on YouTube. So I don't watch much TV, and I love to see these highlights. And on the right of my screen, always I get the sentiment, the market sentiment, because I see these videos, and the video says, months ago it was all about worst recession since 1929, all of this stuff, and nowadays I get sort of the bond market is collapsing kind of thing. Just look at this chart, right? For any one of these sort of brainy guys in hedge funds who just figured out the bond market yields are rising, right? I don't know where these shorts were taking place. Let's just say they shorted it at 100 here on TLT, and it's 88 right now. Whoopee-doo, you made 12%. Very proud of you. But just want to say that this market has been falling since 180. Where were you then? Why were you not making videos saying the end of the bond market then? I mean, these people who are pro-cyclical, and his pro-cyclical videos, I find very amusing. But I have to say, at these levels, that's why I'm excited, because I'd rather be a little bit more anti-cyclical here. And as I said to you before, the 4.25%, 4.5% yield zone, which we blasted through a little bit and we come back in, is an interesting level for me. And therefore, for that reason, I would say I'm waiting for even more sort of people to get short at these levels. Perhaps we do see that, it's time for that reversal. Look at the volume here. All right, on this thing. I mean, you tell me what that means. Market's going down, but there's a huge amount of volume in there. This means a lot of people are still buying. And as I said to you, one other thing we have to clarify, because on any video that I see or any research or Twitter or whatever, it's all about the Chinese and the Japanese. And it's, I'm for because people want to hear that, and so I probably have said too much of that. The Chinese have a program to sell treasuries since about 2019, and probably escalated since the Russian money was confiscated. And I think I can't remember what I worked out, something like 20 billion a month, that they are just gradually every month they go tuck 20 billion and they're regular as clockwork. The Japanese have only been selling to, as far as I could tell, to intervene on their currency. So the last time in 2022, when the yen dollar got to 150-ish, they chucked a lot of treasuries out, got a lot of dollars in, sold them, bought yen. So they repatriated. So they don't have a program. They use it for intervention. And one thing false I said to you in one of our videos, you said, who's the biggest holder? And I said, Japan. And I was wrong. It's not Japan. It's not China. It's the EU, right? The EU are the largest holders of treasuries. How's that? It's not Germany per se, and it's not France per se, but it is the investors of the EU who have been, and I did the analysis and I was kind of shocked myself. What does it show you? What it shows you is that investors in Europe are still concerned about their own currency, and actually the UK investors have also been increasing their holdings of treasuries. So maybe they're also worried about their own currency or whatever. It's difficult to judge, but the EU has taken over as a unit that has been the largest investor in treasuries, which, up to a few weeks ago or a month ago, whenever it is, I did the analysis. I was quite shocked, because I'm trying to interpret what is that,
Well, maybe they're afraid. That is another line I heard, which I thought was actually quite funny. Everybody's afraid of de-dollarization. And what's actually happening is a de-euroization, if that is the right word.
Yeah, I mean, what is going on in Europe is kind of scary, but then it doesn't explain why there are large investments from the UK as well, why the UK investors have also been throwing money in there. It's not as if the gilt market hasn't got a yield on it. I mean, you're getting handsomely rewarded, and in fact, there's more chance of actually getting a rally in the UK market, bond market, than it is, I think, from treasuries. But there you have it. Just to straighten the what's been going on with these holdings of treasuries and foreign holdings. But the most important thing is there's just not enough of them. Right? They're not increasing fast enough.
I've just pulled up the 10-year gilt chart, 4.45% right now. Now it's if I look this, and obviously you always get the question for positioning. I'm clicking back to the TLT at the moment. I also noticed the volume you were just addressing here, which looks a bit like a surrender, what we can see at the moment. And as you said quite rightly, when we were talking about that there is still potential for the way down, the market didn't seem to be bothered too much. And now everybody, as I said, I was lying in bed, not with Corona, but just with the cold. And in every program, everybody is talking about the disaster that the bond market is. It really sounds eerily similar to when somebody calls a top or a low in the market. So as a savvy investor now, Nic, what would you do? Would you say it's time to start collecting TLTs at this level? not the whole position, obviously, but start building up, because if I go into the long-term market in here, we have a low at 78. Now let's take the 20 years as a proxy on the screen. Or the
may I make a comment? I mean, you asked me a clear
question
there, and I hate to sort of not give a clear answer, but as you've got a chart in front of you, and you know that in the last couple of weeks I've been saying it's interesting now. You know, now I'm really interested in this because you're getting a decent yield on this stuff. So the thing that I looked for is, firstly, to see on a chart level, is it plausible that we see a rally from this level? Okay, it is. You've got to, if you look to the left in 2009, you know, we're roughly at those levels where there was a lot of congestion. I don't know if you can see above the, about that level, there's a lot of congestion. So you could argue that, you know, from a classical charting viewpoint, you know, this is as good a place as any to kind of pause. Okay, fine, interesting. But the most important thing that I'm looking for is the relationship of equity versus bonds. So in the two things that I pull up are so I look at SPY divided by TLT, or SPX divided by TLT, look at that ratio. And that ratio of SPY divided by TLT, so you just type in SPY over TLT. So just press go. So you can see that even though I found it interesting, what I didn't see was an indication from this ratio that there was a termination in this trend. And that's what I'm looking for, to basically say, okay, for those people who are kind of in equities and bonds, you know, when do you want to sort of overweight bonds? When do you want to overweight equities? And still the trend is for overweighting equities in the States. But if you look at for example, the DAX divided by some bond equivalent, so there's a Vanguard VETY, I think is one I use, DAX divided by VETY, you do see that there, you know, in the last month or so, as I've been watching this thing, the DAX and the bond market are pretty much moving. The bond market is actually trading better than the DAX. So those are the things that I would look for. So in the States, it's still stocks are going to be outperforming bonds. And therefore, you know, if you want to sort of imagine, so is that, oh, let's move.
I've just put the move on.
Yeah, and in Europe, it's the other way around still. Yeah, so that ratio has hit a support level, so you wait a little bit. But the indication of Europe is sort of bonds over stocks. Indication of States is still stocks over bonds, but I'm looking for this thing to reverse. Move, okay. I mean, a very important factor is the move. And one of the things that I can't remember who I saw it from, divide the number by 10. So it says here we're at 113, divided by 10. So you're at sort of 11, right? And 11 is the equivalent of a VIX. So VIX at 11, and you wouldn't expect bonds to have a volatility of 11. You would expect bonds to have a much, much, much lower volatility. Let's just say around 7, okay, there or thereabouts. So still the volatility of the bond market doesn't justify in a sort of a 60-40 portfolio, or, you know, these balanced portfolios. It's not doing its job. It's not reducing your overall sort of volatility.
I've just pulled up again the playbook, and one of the things I've added for my personal benefit is, again, when we look where we are actually trading, I have these beautiful little buttons here, VIX and move. What are markets indicating us by the volatility regime we're having in here? And surprisingly enough, we've seen the VIX falling. The trend was clearly down. Every time we hit the 13, 12 levels, market perked up again. So we were right on this side. And the interpretation on the move side could now be when everything is fine, we're in Goldilocks scenario. VIX volatility is falling, move volatility is falling. Now we have actually an indication move went up and is staying at elevated levels at the moment.
Yeah.
Which would again represent that we're actually in the reflation scenario. What I expect is actually, if you look down here, VIX going through the roof, move going through the roof, and then we will see our real bull steepener just before the equity markets come crashing down, because then the Fed will realize, oh, we have to take our yields down, which actually, if I say it myself, fits also in nicely with your scenario, that they have to actually screw the man on the street by becoming repressive in the market and simply, no matter what, take the interest rates down to make it possible for the sovereign to refinance itself.
Yes, I must say, your playbook thing here, we've talked about that for years, how helpful this is, and you've overlaid volatility in their VIX and move, is fantastic. For anyone who's trying to make sense of what's going on in the market, just have a look at that. And then you'll figure out whether you are right or wrong. And the only thing about the playbook is that for all of those people who were focused on recession, would look at the playbook for recession and say, well, what would I expect to see in a recession scenario? And coming back to a recession scenario, what works in recession is the dollar goes up, right? So at the moment, the dollar is kind of going up, but it's not really going up. It's been much higher. So the signals for recession are the dollar goes up, treasuries start to rally, risk assets fall, gold goes up. I mean, those are the kind of the four kind of major market factors that you would look for recession. We didn't really get all of those things, at the end of 2022. We actually saw, the dollar peaked, dollar started to fall from 115 down to, went down to basically parity, and now it's at 106 or thereabouts. Treasuries didn't rally, they were still falling. Yeah. So, they got that one wrong. That's why this chart here is a very, very useful guide to basically say, what permutation have I got in the market which fits closest? And you've gone through this, a few times right now, and you're basically saying, well, I think we're in this kind of still in this expansion mode. And that's the indication of the data. You just mentioned gold here, you actually mentioned the four harbingers of the apocalypse, yeah. And gold is actually one of these things. I'm also looking very close at the moment. Gold is doing fantastically well, considering the interest rate regime we are right in here. Yes, but you have to, again, obviously gold has lost, and I think a month or so ago, I said to my clients, don't be surprised if gold falls, 100 or so bucks, down to 1700 something. We were in the 1800s. But you're right. And it's not just gold that is, I actually met some people who store gold, fascinating discussion, what's going on. But, you're right, gold is holding up, but also, and you showed me a chart a few weeks ago, stocks are holding up versus real yields. Yeah, it's these real yield, where we stand right now in the real yield, and real yield basically means the nominal yield of treasury subtract by the inflation rate or the inflation expectations for that maturity, if you like. The real yields are sort of 2% plus, and that's really high, and that's very, very restraining for an economy. And I don't think you can imagine that if you were either in government, and I can't imagine that the Fed really believe that they should be turning the screw tighter, even though I must say, I have heard some ridiculous comments from Fed officials saying, well, we're still not happy with inflation. Sorry. Just ignore that for a moment. And there are also people with sense in the Fed who, in my view, sort of realize that they should be pausing at the very least right now and wait and see what happens, because the level of real yield is just so high. Yeah, they don't care where gold is, but gold is doing really well because, every central bank in the world is buying. It's number one. Number two, and also, by the way, everyone realizes that the US government, the German government have only one choice, and that is to debase the currency. And that is why things like Bitcoin have done really well this year. Gold has done really well this year. Equities have done really well this year, because the thing you don't want to hold in a debased currency is a market where you're not being rewarded enough for risk, and that was the bond market. You are now reasonably well rewarded, in my view. So that was off the cards, and everything else did well versus bonds. It's not just gold.
Yeah, I agree. What we can see here on the chart again, if we actually have this bear steepener here, so we've taken one step beforehand, yeah, and one of the mistakes beginners make, they think always the quad model goes in circles, around and round and round. No, you can jump between the different sectors. So we took a step forward. We had the inversion 2 years, yeah, they were pumping it up like crazy, and for whatever reason, we are now seeing the bearish steepener as it would be in line with an expansion scenario. What also fits in there, oil prices. Yeah, oil prices are always late cyclical before the shit hits the fan, and we're seeing this right now. So I have a little part of my portfolio which I completely blindly allocate in this simple model. Yeah, I should have done more than I would have done had a better performance, but it's eerily benign what you can see here when you just follow the normal steps. But at the moment, as I said, I'm not getting my head around. We seem to have been flipping back, and that was the original question which I also had, is this, and you answered it obviously, there are no buyers at the moment. That explains the steepening yield curve. People are reluctant at these levels to put money on the table to lock in, I don't know, 4.5%. Well, and when we have this scenario, going back to the TLT actually, for, well, let's call it actionable trade, if we actually can say something like that, with the high volume in there and the duration, it tells us 16, that we could see another breakdown, a final breakdown, down to 82 levels. Well, I definitely would want to say, yeah, fine, now we'll finally see the flip, and we will see a steepener, but the steepener will be a bullish steepener this time, because the Fed will have to, without any doubt, also taking your scenario into consideration of they will have to, otherwise the sovereign has a problem, to get exposure into this market. So it's getting really, really interesting right now. As I said, I've been wrong at the beginning of the year, but I'm in good company. Yeah, Jeff Gundlach was also wrong. So have you heard his take on the markets recently? Because I wasn't following him too much.
No, I must say I only look at the videos on the right. So if you're not in the video on the right, then you don't get shown in my thing. And they better be better than the golf video or the snooker video. But yeah, there was something you said that just needs qualifying. You say there are no buyers. There are an immense amount of buyers right now.
At the right level.
We would be already at 82. And you can see the volume. You know, all the guys who have just figured out that rates are going up in the 10-year who are shorting it in the hedge funds they got to sell to somebody. And obviously, it's just that the buyers are not enough right now, and the sellers have more urgency. And, so we have to let them reach the level at which there is, an equal buyers and sellers. The market has to kind of find its pause. It still hasn't found it. Each time I keep thinking we're there, we then suddenly get another 10 basis points. I remember I started to look at this thing when yields were 380. I was saying, okay, all right, let's see. It's getting interesting here at 380. It's not allowed to cross 387. Crossed it. Bang, 4%. Okay, it's not allowed to cross. And it just keeps moving up and up and up. The thing which is not moving, which is fascinating, I think, is the 2-year. So the 2-year is, for all its faults, you can see, okay, we're at a new high. You just sort of say, Nick, you're wrong. Can you go on a smaller time scales? Because that's on a monthly, I think you've got it. So so if you have a look here, right, this big drop in March, right, was the Silicon Valley thing and all of these other banks who just went poof, as it were. And that was the point where I think the market effectively truly believed that the Fed were going to be forced to pivot. The Fed totally ignored what was going on in the other banks, and then they carried on. And then the market suddenly realized, oh, shoot, the Fed isn't listening to these things. They obviously don't see a banking crisis. And so yields went up. we're at the same level as we were. Go and do the same for the UK 2-year, go and do the same for the German 2-year. And they're all at this level, which makes you think that, you know, again, the market is sensing that we have reached that peak in rates. And now it's about fixing the yield curve shape. You've peaked the 2-year, you're not going to raise rates anymore. What does the yield curve need to look like? Where is value across the curve? And, you know, and obviously the expensive point of the curve was, in fact, the long end, because you were not being rewarded for that, you know, buying 10-year versus buying 2-year. And the only time you would buy a 10-year is when you actually think rates are heading lower. Yeah. So you'd think, okay, yield's going to go from 4.5 to 3.5 because they're going to get more bang for my buck. Right. And that's the point where you shift the thing. At the moment, you'd say, okay, well, 10-year needs to normalize. Kind of, we don't know where that level is going to be. We don't know the right number for the term premium. We don't know where that should end up. And so we just have to watch these ratios and chart patterns and things like this to get a sense of it. It doesn't look over there. You know, when you look at the chart pattern, it just doesn't look over. Look, you know, there's a little bit of a pause here. You know, maybe we head up towards 5%, possible. But it, you know, in America, at least, it doesn't look like they have reached that level where there is going to be a pause. Maybe it is 5%. I don't know.
Let me close that off with a question which is also going through mine. I've pulled up the high yield HYG ETF here. And in my, let's first go into a longer time frame. I've mentioned that before. Down here, you can see 2008, yeah? The real disaster, when the world was about to end, and it almost was about to end. And then we took this settled decline from 86, where it was on average for a very long time. And nobody actually, since November 21, put too much attention on this point, that we went down from 86 to 73 in the high yields. Now we have established this level here around, let's say, call it 73, yeah, which could also be seen as the panic average at around 08. So my question now is, if I want to put that into the whole framework, that I say, yes, I understand your points, the government will eventually, or the Fed will eventually have to save the sovereign in this whole scenario, because there's no other way out. What is going to happen when we also mentioned this on our conversations a while ago, or regularly even, when the wall of refinancing hits the whole zombie companies, and that is forecasted to happen, well, pretty much from the second quarter in 24 on, when the refinancing has to come in. Does the relatively subdued high yield market at the moment, going back to June 22, represent that the market participant actually foreshadow what must not happen, cannot happen? Therefore, that is a bottoming out level we are seeing here? Or is that just the beginning of the end, and we'll see the real disaster happening on high yields? Any thoughts on that, Nic?
Well, okay, so on the refinancing wall, you know, what does that do? That impacts companies' profitability, right? So at the moment, companies are very happy because, in fact, I looked at a study which basically said the American companies have financed for the longest duration. So they have the problem, if you like, much later than, let's just say, other companies around the world. So, you know, what they've been doing is they've refinanced, let's just say, at 3%, and then they stick the money on some money market fund for 5%. So that every time Jay Powell says, I've raised rates 25 basis points, they say, whoopee-doo. Thank you very much. We're making even more money. So the problem, as you rightly say, is, well, you know, when that 3% runs out, so if you borrowed in 2019 and you got 5-year loan, and in 2024 you've got to refinance that 3% to now, well, it won't be 5%, it'll be something like 7%, let's just say, or 6%. Can your business afford it? And irrespective whether it can afford it, what's likely to happen is that your profitability will be lower. So this impacts profitability for kind of a lot of the leveraged S&P companies. And that's why, you know, for people who are raising finance now or running out of cash, you know, they're still in the doldrums and they're not rallying because financing costs for these companies is immense. Yeah. So that's a problem. The thing about, is this thing going to rally? I actually don't follow the HYG. I look at J&K, but I guess they're all the same thing. And I look at the option adjusted spread for US and EU corporates, and they're at like, 4% thereabouts. Well, 4% spread for a high yield sounds like a lot, but it is kind of a low end of the range. If interest rates are stable, you don't mind sitting there with owning something at a tight spread because you're just picking up extra carry as long as the spread's not widening. And the only time you'd want to eliminate your corporate holdings is if you think that, the economy is changing direction and then spreads will start to widen. So if there's stable markets, it will be fine for the high yield. Is it particular value? No. But value only comes if you look at the outlook and say, well, I expect rates to stay at a certain level for longer. There's no problem with the economy. Everything's fine. And then I just sit there and make this extra carry. But spreads are very tight right now. And that's also, upset a lot of the doomsters who keep showing charts of, corporate defaults. The wall of default is a gradual one. It's not in 2024. It's 24, it's 25, it's 26 and 27. And by that stage, maybe the Fed have kind of changed their mind on the whole kind of game. And we've got, 2.5% inflation. And therefore they're saying, well, actually 2.5% inflation, what are we doing here, guys, with, 5.5% interest rates? So, the world could be different by then.
Very interesting. While you were explaining this, I actually had the trading screen up and I was checking HYG. A 1 year straddle is around 7% at the moment of the HYG, what you would pay, with a duration of what does it tell me here, 3.6 years, because it's a shorter term. The market is actually pricing in 200 basis points on the shorter end in both directions possible, which is actually a very interesting observation, that the forecast is, yes, whatever, as a market maker, somebody would say to me, oh, I want to be long or short HYG. I don't care. Either we see a normalization back to 86 or the bottom falls out and we are ending up at 60. The market is very eloquently pricing that in. If you want to buy that as a market maker, most likely the market maker in a year's time will make money. So we have already established a corridor right here, just by what the option market is telling us in this scenario. However, I would obviously like to take a direction in this market. And as the market is always not seeing it until it starts panicking, we mentioned the volume on the TLT earlier, Nic. What you see on the HYG, we haven't seen the surrender here yet, have we?
Yeah, but I mean, I'm not sure that you will, to be honest with you. There has to be a reason for a surrender, a capitulation, if you like, for HYG. I mean, we talked about the 2 year. 2 years not moving. The duration on the HYG is 3.5 years. Yep. So do you need a capitulation? It's not really something like the TLT, which is a long duration instrument. And therefore with TLT, you've got some capitulation, or you've got some people looking to short this thing. But whereas with a low duration thing, if the short end is not moving, I don't expect too much for this thing, because on the downside, I'd have to be thinking of doom and gloom scenario on the economy. At the moment, at least for the next 6 months, there is no doom and gloom. I don't think so. We have to take it a bit at a time, but let's just say, next 6 months you're okay. So therefore downside, well, what's going to hurt me? Is it the interest rate risk? Not much. 2 years, I don't expect the rates to go up in the 2 year. So interest rate risk, not my problem. Credit risk isn't my problem. Downside, I'm not particularly worried, frankly.
There would be another positive data point actually for the TLT. If we see a disaster on the HYG or the junk side, the market for high quality will be swimming in liquidity.
Yeah, so that's right. You would expect to see people doing at least a switch to something of theoretically quality. At the moment, quality is anything other than bonds, right? So the quality trade is I go buy stocks. Quality traders are going to buy gold. I go and buy Bitcoin, and they're all quality. Would you believe, as opposed to something which is not quality, which, you said Bill Ackman said the contract from the government is just not good enough. Well, he's damn right. I mean, frankly, with a expansion of a budget deficit of 6.5% per annum, or at least that's the funding requirements, 6.5% per annum, that's phenomenal. This, as I said, this destroyed the Liz Truss government, unfunded liabilities. And the only reason the Americans can get away with it, obviously, is because they got the currency of choice. And the market is still allowing it. So, how long can this go? I just don't know.
Well, let's put it that way. Then I'm actually quite fine with my positioning at the moment, sitting on the sidelines, earning roughly above 5%, hoping that I will be able to benefit from the inevitable, let's save the market. Just the question when this is going to happen. Interesting conversation, obviously, on the equity markets going on. Will we see a year-end rally or not? Just by what everybody tells me, everybody seems to expect a year-end rally. Do you hear different word?
Well, it worries me when people are the same way, and because I'm used to people being so opposite. But I am of the view. So what we've seen in your Elliott language, as you mentioned Elliott, so I say it. So we've 4,600 was a target for the end of a wave 3. We're in a wave 4. Wave 4 should go down to somewhere between 4,200 and 4,300. We are there or thereabouts. We might get one more low, kind of an up-down thing, and that should be it. What it's not allowed to do on the current count, if you like, is that we're not allowed to go below 4,100. So whilst we're sort of in that 4.2, 4.3 range, don't care, it's going up, right? New high. And I think you just have to get used to that. And, people can say, well, where's it coming from? Could be coming from the rest of the world, yeah. Unfortunately, as the liquidity measures, so we didn't talk about liquidity today, are still bouncing at low levels, right? So they're not supportive for a rally at the same time where the Treasury is trying to fund. So it's kind of a perfect storm at the moment. And all hell's still breaking loose in China, but China have thrown a lot of money at the problem. They may not have thrown enough. That's the only issue that, leaving with a negative here. I hate that, but that's the thing we need to watch and be cognizant for, the things that could go wrong.
Let me do a final plug. On Wednesday, we will be ready for Murad's Monthly, the second issue, going into relative strength and momentum, pure market data. He was fantastically accurate the last time, seasonality in. So I'm actually quite curious what his data will tell us for the shorter term. We can see at the moment in the markets. Nic, thank you very much that you spent time with me. Obviously, I can't infect you with my not corona over the airwaves, and I hope my voice will be a little bit nicer again on Tuesday or Wednesday when I shoot the thing with Murad to get it on the block. And let me remind everybody again, on next Sunday, Nic and I will be not on the air. We'll be on the air then on Monday and give you a full run through what is happening in the political systems in Germany, which I think will have massively impact on European policy. And with European policy, obviously, we're talking about interest rates, we're talking about inflation, we're talking about the whole, are we drifting into socialism, or are they going to pull back? You know my opinion, I'm not very hopeful. Communists always double down at the end. They never correct their mistakes. So we shall see what's going on there. Nic, any last words from your side?
Well, a plug for Murat, I must say, because this kind of analysis is very, very useful. And when you see things moving in the markets, Hang Seng and this, you say, well, is something of use coming out of that information? My go-to place is the RRG chart. So Murat's Monthly is very helpful for that.
Thank you very much. I'll pass it on. Well, he's one of our listeners anyway. Thank you for being our guest tonight. Leave a comment, share us, and like us, and we see you next Monday. Bye-bye.
See you. Bye-bye.